Simon Brown with Funds Friday. Today I want to look at smart beta exchange traded funds, ETFs. What is smart beta? And then we will delve into the sort of the bunch that are listed on the JSE. And there's a fair bunch listed on the JSE. If you've got questions, drop them into the Q&A box. I'll take them as we go along. Or if they're not time sensitive, I'll take them at the end of the presentation. I suppose first point is beta is market. Generic index, and that's why you will often hear, the phrase used, beta stocks, but stocks that move with the market, and it's why the search by the active management is for alpha. Alpha is beating the market, so beating beta. Beta is just like the stock standard. So a beta ETF, which is your top 40, your S&P 500, your MSCI, Ashburton 1200, Indy, Resi, all of those, they're tracking the market, and they're generic indices. Now, we can debate how the indices are put together. Usually they're going to be market cap weighted, sometimes a little bit of light change. And for example, we've got a top 50 from core shares. That's not a smart beta. It's just an extra 10 stocks compared to the top 40. So it's just a normal beta. Smart beta is a smart index. It's using other objective and factors, and some people would say subjective, but typically objective factors, things that we can measure nice and simple, and use that to construct an index by one of two ways. Either you use those objective factors to determine which stocks go into an index. Alternatively, you would use that to do the weighting aspect of the different weights of those different stocks. Smart beta, often more expensive because you've got a smart index and there's a fee associated with that that is often higher. So Satrix 40, for example, they pay to use the top 40 index as their benchmark. But if you go and get a smart index, you often pay more. So you often find the smart betas are perhaps a little bit more expensive. The question is, does it work? In essence, what the smart beta is trying to do is say, market performance is great, but can we give market performance plus a bit? And if you can, you don't mind paying the extra fee, and then you've got in theory, superior ETF. Does it work? I hold the smart beta called Smart, which was the equal weight from core shares, and I got a property one, and we'll delve into them when I get to it. But the does it work part, the jury's probably at best we can say still out. I think there are pros and cons. I'm not that convinced. Every time a smart beta comes to market, there's back testing to prove that it works. I'm not convinced. Let me put it the other way. It's not that I'm not convinced by smart beta. It's just that normal beta, to me, serves my purpose. And therefore, I'm like, so what do we need the smart beta part for, I suppose? More than anything, perhaps, is my question. Core shares, who to a degree have sort of positioned themselves as the smart beta ETF house, they've got four. The first is Smart. So this was the equal weighted. Initially, it was the Nedbank Beta equal weighted, and then they were sold it to Core Shares, and Core Shares then changed it into a smart ETF. And what they do is they've got 6 different valuation methodologies rolled into one. So it is value, it is low volatility, it is momentum, and so the list goes on. And so that's why they call it smart. In a sense, it's the pinnacle of smart. Rather than picking just one or the other, they've kind of rolled them all into one. It's had a fairly dismal time relative to top 40. That is truthfully lack of NASPAS. If you don't hold NASPAS in a fairly chunky position, you're going to underperform. And then more recently, of course, mining stocks as well. But really the big issue there is NASPAS. The other one from them is the CS Prop. So Core Shares had 2 property ETFs, the top 10 equal weighted, and then the one track in the South African property index. And they rolled this into one property ETF. And the difference by this, the other property ETFs that are out there very much just do a market cap weighting. Here they weight by yield. In other words, by that dividend yield that property company is paying out. And what that, I like that idea, because what is the core reason for owning a property stock? Well, I mean, apart from the diversification, the lack of correlation with equity as a rule, it is around yield. It's about getting, that better yield coming through. So I intuitively like that idea. I was holding the equal weight, and now I hold this one. It's still relatively new. The sector's had a really, really tough time of it. But to me, and I suppose it's part of the point, the harder it is to understand, then a smart beta, I suppose the more nervous I tend to get. And then they've got their two dividend aristocrats. Locally, there's the DivTrax, and then offshore is the GlowDiv. That should be DIV, not DIX. And what that is, it's not looking to pay high dividends. It's more focusing on dividend yield as a filter of quality. So, for example, in the offshore one, the US component, you need to have a 25-year track record of paying dividends. So, as I often say, Apple's excluded because they weren't paying dividends 25 years ago. Google, Facebook excluded because they weren't listed 25 years ago. Amazon listed 97, so excluded. I mean, there's a bunch of the sort of new stocks that are simply not there. And what you do then get is a bunch of the more consumer staple type stocks in there. It's not necessarily, it has a dividend yield. It's nice, but it's not a knock it out the park because dividend yield is really not its focus. The focus is just dividend as a metric of quality, and that's a fair shout. I can intuitively, a company that has got a 25-year track record of paying a dividend is let's go back over the last 25 years. That includes the dot-com crash. It includes the 2008, 2009 global financial crisis. And then, of course, it includes the most recent 2020 pandemic, which means these are companies that are robust. They are making sufficient profit to pay dividends through all sorts of market conditions. And that tells you something about those companies. It certainly tells you it's not a Tesla who doesn't pay a dividend because they hardly make profit. But it does say to you, these are, for want of a word, they are boring. But, at times, boring has its place. Satrix has got a couple. The Satrix RAFI Research Affiliates Fundamental Indexation. So there were a bunch of RAFI ETFs on our market. ABSA had a couple, but then they merged those into Givy, and then they deleted all but one. And what they do is they take they take 4 fundamental metrics and use those to determine the stock. So they start with the universe. All ETFs are going to start with 2 filters. The first filter is probably just a good old-fashioned size filter. You don't want a penny stock in there because of issues. And then your second part will be liquidity. Even a big stock, if there's not enough liquidity, is either going to get downweighted or outweighted from an ETF. So they then bring in some sort of fundamental data, price to book, cash flow, etc. The Satrix RAFI, which I hold for my niece and nephew, has actually done very well. It's actually performed very, very well. As I said, it's the last RAFI one we have. The Satrix Divi, again, dividends are not, the dividend yield is not the core focus. This is almost a contrarian sort of ETF. What they do is they use the forward dividend yield. So I think they look at the top 100 stocks on the JSE, and they take the 30 with the highest forward dividend yield. What I mean by forward dividend yield, in other words, next year's dividend yield. What are they expecting the dividend yield to be next year? And they then apply that into the current share price. And what you get is, the risks are that the share price has fallen and the dividend has not been yet announced, so the expectation hasn't adjusted. So you've got a fall in share price, but then the dividend falls as well. And stocks that have been in here that have fundamentally lost their way, PPC, African Bank. So certainly there are risks in that space where quite simply, you end up with just a stock that was on its way to bankruptcy and just hasn't yet got there. Lawrence is saying, can't see screen. Definitely sending because I can see it in 2 places. We are recording. As soon as I'm finished, it'll be up on the YouTube channel. In fact, you can go to the YouTube channel now. We're streaming live, so you could catch it there instead of. It's contrarian in a sense because, often it's fallen stocks. Now, if they recover, Kumba would have been in there for a while, and then it fell, and then it goes back in, and it's massive uplift in Kumba. So it's a fairly simple methodology. The problem is I don't like the idea of forward dividend yields. Whose forward dividend yield? What basis is it being readjusted? All of those sort of questions sort of bother me. Satrix Momentum. Momentum is basically just buy the winners because they tend to keep on winning. I'm a big fan of Momentum. I own the ABSA Momentum ETF. I prefer its methodology to the Satrix one. And what I mean by that is that ABSA has a longer look-back period. I consider too short a look-back period, and I don't like. And I used to trade a momentum strategy, and these days I now just buy the ETF. So African Bank lost its way. So as the bank that you would be transacting with these days is perfectly fine. But 6 years ago, African Bank was a listed company that went bankrupt. They took the good bank out, and that's what we know about now. And shareholders were left with the bad bank. So when I say African Bank lost its way, I mean the listed entity, not the banking entity that you can now get loans from. And then a Satrix Quality. And as is often the problem with these, is that the amount of information around how they construct the index is, so it's just S&P index, fairly scant. And I like my information. Truthfully, I could have gone and done a much deeper dive on the quality to get the sense of it. But the minimum disclosure document just say we track the S&P quality, South African S&P quality index. Nice. What makes a stock quality? What is it? Is it booked price to book or whatever the case is? And then ABSA's got a fair bunch. They've got their managed volatility, and they've got three, a high risk, a moderate, and a defensive. And the idea here, they came out fairly recently, a year ago or so, I suppose. And the logic with them is that as volatility increases, it starts moving into cash. Now, when markets are crashing, like we saw back in March, volatility is at its absolute high point. When markets were in bull market, and I'm talking offshore markets, when offshore markets were in bull market phase up to the collapse in March, volatility recedes to what was then record lows. So volatility is a nice sort of warning of impending market collapses. It's not perfect, but it certainly works. So what it does is, for the defensive, at a certain level, I think it's 8% of volatility, boom, it starts moving from equity into cash. And then the high risk one, I think it's 20%. It's moving from equity into cash. So the theory is that as markets collapse, it'll swing into cash, and it'll have a higher cash weighting. In other words, protect you from downside. And then as markets recover, it goes back into equity. Your defensive one will typically underperform in the bull markets because it'll probably have some level of cash, whereas your high risk will go full equity. But then your defensive one will do much better in collapsing markets because it will swing into cash fairly quickly and exit the equity. They've also got a value, a momentum, and a low volatility. I own the momentum one. The value is just good old classic value, which is price to book and metrics such as that. And then low volatility. Volatility is how much is a share bouncing around. The logic being a low volatility share is lower risk, and so therefore you can get quality companies, but you can get them at a lower short-term price risk. And then they've got the Give ESA. So as I said, ABSA had a series of RAFI, Research Affiliate Fundamental Indexation, switched those into Give, and then they had a Resi, a FINI, and an ND. They shut those down. They've got the Give ESA. It's a Global Intrinsic Value Index. So what it's doing is using intrinsic value to weight the shares. And it takes the top 50. So in essence, it's a top 50 ETF rather than a top 40. The weighting is then done by that intrinsic value. Question coming through, which do I hold of the smarts? So I've got the NFE Momentum, this one here, the ABSA Momentum. I've got the RAFI in my niece and nephew's account. And then I've got Smart and CS Prop. I like the idea behind the smart, but it might be too smart by half. And truthfully, I'm not liking the performance. But we'll see how it. I'm always slow to respond. I'm never going to jump too quickly, so I'm going to park that there for now. What I do like with the smart is that, for example, in the top 40, your price return has basically been driven by about 10 shares, and actually that's. Typically indices around the world, with an exception, and oddly enough, the exception is Italy. Italy, your index has been driven by about about 5% of the shares. Otherwise, typically indices, market cap based indices, price movement is driven by about a quarter of the shares. So even in the S&P 500, your price movement has been driven by about 100, 125 stocks, not the full 500. Top 40, it's about top 10. In the CS prop, it's like 26 of the 30 odd. In the smart as well, you get more of the stocks that are having an impact, which is important. So those are the ones that I own in this particular space. Fred. No, the Givey SA, Fred, is local. So it is a top 50 JSE, although they do, it is the indexation process, I need to go back, is a global intrinsic value index. That's just the name that they give to it. It is South African shares. It's a top 50 in the South African shares. Did I buy all your smarts via OST? Yeah, well, so not all. I mean, I'm either, why I'm pausing. So my main equity accounts, etc., is with OST, but then I also have ASI, which is Auto Share Invest, which sits within internet banking. So I buy a monthly debit on ASI, internet banking, but the others are all sitting in my OST account. Yeah, so there's a whole bunch of ETNs from UBS. So I'm going to actually do a whole series on them. So what we're sitting with here, so an exchange traded fund is typically what we look at here, what we've been talking about, and what we know about. And even the ETNs typically either track an index or got a single commodity into it. And then what UBS does is they do what we can call wrappers. In other words, me and you can go and start a fund, and it could be passive or active, and we put it into one of those UBS wrappers, and therefore it's available on the JSE. So they're not being issued by UBS. Well, they're being issued by UBS, but the underlying assets are being managed by third parties. Because they're ETNs, they have expiry dates. In many cases, they're more active, and I'm going to start delving into a bunch of those. Some of them seem to have expired just recently, and in fact, it wasn't that expiry date, it was early expiry, but there's some interesting looking ones there. And I mean, for example, there's a Reitway Global who they specialize in offshore real estate investment trusts. And they've got one listed on the JSE. So, sort of interesting ways to get into other sort of asset classes and the like. There's a tech-focused one as well. So I'm going to go delve into those and get some more sense about those in time. We'll save that for a future Friday at some point. Ladies and gents, not seeing any questions coming through. Sean, yeah, so I mean, smart beta is... So you're asking two questions. The one is, we've seen a bunch of it, and yes, anyone can put any index together and call it smart. Absolutely. And, not to discourse shares, but their property one, they based it on an S&P, Standard & Poor Dow Jones, but ultimately they did it their own way. So you'll see on the minimum disclosure documents, it refers to it as a bespoke index. But now the rules are in place, and I suppose that's what's important. You could use almost any methodology, but then the rules are in place, and that, as long as it's passive and it sticks to those rules. Otherwise, it's an active ETF or ETN, and you can have those. We don't, but you can. What's important is that those rules, and then it's up to us as the investor to have a look and make that decision and decide for yourself, does this work? Do you agree with it? Some of them I look at, in particular the Givey, not so sure about. The quality, just don't know. Satrix Divi, I've owned it, but and it's done well at times. The Rafi, done excellent, not bad. Dividend aristocrats, I get the logic. Smart, less so. So it's about delving in and making our calls in that sense. Ladies and gents, not seeing any further questions coming through. We'll park that there. Everyone have a great weekend. Stay safe. We're back with Deneo on Monday, 10:30 Market Standard, and then we're off to the races again. Cheers all. Have a good weekend.